inflation does increase the price of goods and services over time, and it erodes the purchasing power of cash. As the value of money decreases, generally the price of assets such as real estate tend to increase.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today we are going to talk about inflation. I've heard a lot of misconceptions about that inflation and what it's going to do to real estate market, especially the investment in syndication real estate market, because you really need to look at the real estate market into the submarkets, not just real estate as a whole. A lot of what I've heard is that, with the Fed fighting inflation, raising interest rates, it's going to hurt the economy and the stock market, and it obviously does directly impact the costs of borrowing for both everyday purchases and buying owner-occupied single-family homes for sure. So the question is, why should you still invest or look at investing in real estate and syndications when there's potentially a recession looming and overall things seem kind of bleak? With the potential recession and clickbait and headlines, when you turn on the news, you'll just see, housing volumes are down, interest rates are rising, it's unaffordable. And some of those things may limit the single family housing market, but at the same time, some of those actually help multifamily. A lot of headlines about commercial real estate struggling, and absolutely on the office sector for sure, there's going to be a reset there. Had a conversation the other day that even some of the commercial office buildings that show 100% occupied, when you know internally what the company that occupies that space is going to do, they may be planning 12 or 18 months out to just vacate the entire space, hundreds of thousands or millions of square feet. So if you look at the data for a building and it says 100% occupied, it might be 50% occupied in 12 to 18 months because it's got a big corporate tenant that is just not going to default on the lease. So there's going to be a lot of pain in the commercial space for sure, but at the same time, that does not necessarily affect multifamily or self-storage or some of the other asset classes. So I want to talk a little bit more about inflation at a high level and then really go into some of the more specific niches that may actually be helped, or at a minimum, it's a good hedge against inflation and it's better than sitting in cash. So real estate is often been considered a good hedge against inflation. It's a leveraged, assuming you have fixed rate debt and reasonably conservative leverage, you're borrowing, and when there is inflation, when you have to pay that loan back, you're paying it back with essentially a lower price to dollar at that point. So you're getting the benefit of that. But inflation does increase the price of goods and services over time, and it erodes the purchasing power of cash. As the value of money decreases, generally the price of assets such as real estate tend to increase. Real world example of that is I was in Argentina last year, and they've had rampant inflation, 50% plus for really a generation. And they essentially price real estate in US dollars. So the price of property goes up 50% a year because pretty much most major sellers are just kind of indexing to the US dollar, and they just raise their prices accordingly. Rent also goes up with inflation, especially with the multifamily kind of 1-year leases. It has the ability to adjust, and we've seen a lot of that. So a few reasons why multifamily and the syndicated real estate space is a great place to be regardless of inflation. Because the Fed is trying to reduce inflation, they've raised rates, and by doing that, they've made it harder for borrowers to afford to buy homes. Thus, the remaining pool of potential buyers have become renters, and there's a strong demand for rental apartments. And those that bought homes in the last 3 to 5 years did so with 30-year fixed rate debt, and 70% of the population either doesn't have a mortgage or is locked below 4%. I believe the breakdown is about 40% of people actually don't have mortgages. It's probably a lot of the baby boomers, but it does vary. And the remaining 30% have locked in below 4%. So there's a lot of people stuck in their homes, and we have a number. I have a lot of real estate broker, real estate agent friends, and actually a number of investors. In our funds are real estate professionals. Both on the agent side and or the landlord side. They're seeing just record low inventory. No one is selling unless they absolutely have to. So with this low inventory, there's not going to be as many renters buying houses in the next few years. They're not going to be able to find one, and the ones that are available are often still unaffordable. So higher interest rates make it much less affordable for potential first-time home buyers or renters to buy homes. The next question is, does it actually hurt investors? So if you've bought an investment property with fixed rate debt a few years ago, you're in a great spot. You've got low interest rates, and the real value of the debt is essentially decreasing because what you owe is fixed, you have a low rate, new people have higher rates. With inflation, the cost of dollars is actually decreasing. So when you ultimately pay back that loan, it's with dollars that are worth a lot less than they were when you purchase a property. Additionally, cash flowing real estate is providing a steady stream of rental income. So if you are cash flow positive, then you're actually already paying your debt, and your debt is decreasing in value. Additionally, with inflation, especially residential rents, they typically reset annually. So you have the ability to raise rents with inflation. Now, in some cases, operating costs may go up, the cost of labor, repairs, materials, they will go up as well. But if you've bought with 50, 60, 70% loan to value, one of your major expenses is debt. So ultimately, cash flowing real estate typically does come out very much ahead with inflation. Lastly, real estate is a finite asset. There's a limited supply. There's a limited supply of land. There's a limited supply of buildings. As the population and growth continues, the demand for real estate is continuing to increase, potentially pushing up the values. And inflation does increase the construction costs. So it's more difficult to build, and in the area we focus on heavily, workforce housing, middle class housing. It's tough to build those. Most of the building is at the higher end, the Class A, the more luxury buildings. So that's the only thing that you can afford to sell. It costs so much to build, you have to sell it towards the high end. So that leaves a lot of room for the value add space, and that's where we play heavily, and there's a lot of content about that. So what does this mean in the real world? We're in over 40 deals, and we've seen this inflation play out across the portfolio, and that includes growth markets like Dallas, Phoenix, and stable markets. Like we're in a deal in Dayton, Ohio, we're in a deal in Indianapolis, Indiana. And across the board nationwide, we're seeing rents increase with inflation. There's been a few articles that, rents have peaked or that rents are starting to decline in certain markets. On the high end, I mean, that's certainly the stats are what the stats are, but it's important to look at the sub-market and the individual asset classes. And what we're seeing on the more, I'll say affordable housing, workforce housing is probably the proper term, but these are Class B, Class C plus type assets. There is just such a limited supply, and when you have a newly renovated unit and a value add, the demand is high, rents are increasing, and also just on lease turnover. There are properties where the prior owners just weren't aggressive at managing their rents. They didn't realize how much rents had went up, in the neighboring communities, and often we're seeing 10 to 20% increase in rents just from a turnover and a renewal without having to renovate. And tenants are willing to pay it in many cases because they look around to the neighboring communities and they're all a few $100s more a month anyway. So the rent increases do get passed on. So we've had some pushback lately on sort of what returns should be. A lot of people have said, well, we can get 4.5% of the bank account, we get 5% with treasuries. Those that have been spent the better part of the last 10, 20 years not receiving any interest rate at the bank, getting excited. Keep in mind the inflation was at 9% last year. The most recent statistics showed that inflation dropped into the 4s. However, they play with these stats a lot. There's a website called Shadow Stats that tracks what inflation would be if they use the old way of calculating it, and it's significantly higher. So if you're making 4 to 5%, you're basically at best you're breaking even, but you're still probably losing money. if you're just getting 5%, it's really not enough. Most real estate syndication deals will pay, at the lowest 5, but often up to 7 or 8% on a preferred return, and you're getting a percentage of the profits of the deals. So that's a significantly better hedge against inflation. You're getting both that cash flow, whether it's paid quarterly or in some cases accrued for the first year or two, but you get paid that amount of money first, plus you're getting a percentage of profit. I think it's a significantly better hedge against inflation than just putting money into treasuries. So on a personal note, I'm recording this episode and about to fly to Hong Kong. In 2019, I did this executive MBA program, and part of that was just wanting to get outside of the U.S. and just understand world economics a little better. Really excited to be there, and I know one of our professors is going to come back, and there's a seminar on Saturday, the day before graduation, that's just going to go through macroeconomics. So I'm excited to hear kind of more of a global perspective of things. I worry sometimes, the media bubble here, the clickbait, the headline grabbing. It's just going to be interesting from a perspective of, and this guy's a Columbia-trained PhD in economics, so it's going to be just interesting to hear, a more global perspective on what's going on with inflation and the overall economy. So I'll report back on that in the coming weeks, and also probably do a little bonus points and miles episode, because I used some Chase points that I transferred to Korean Air, and I'm going to be flying Korean Air first class. So only on miles. I don't even have the money. I wouldn't spend $10,000 on a ticket for that. So, but those interested in points and miles, I'll probably have some pictures on Facebook and Instagram. Certainly, a lot of business owners listen to this. If you're looking for tips on how to maximize your points and miles, please reach out as well. We launched a Facebook group for the Alternative Investor Mastermind. So, if you're a Facebook user, or even just if you have it and you don't really post much, check out the group. We're going to be posting some exclusive content in there, and really just building a community. We're hoping the community can kind of take a life of its own, and people can exchange thoughts on strategy, tips, ideas, investments, what's going well, what to be careful of. And be actively involved in the community, do some live streams, and really try to just build it. It's the feedback I've gotten is a lot of people are looking for really just where to go, just like a mastermind group, a trusted group to be one of the first places to look when you're curious about something and want to learn more from like-minded people. So please check it out. It's the Alternative Investor Mastermind Facebook group. We'll put a link in the show notes. So that's about it for today. Thanks, everybody. Please, if you like what you're hearing, leave us a review on Apple, iTunes, Spotify, YouTube. Like and subscribe. Smash that notification button. We'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.